Good morning. It is Sunday, the 18th of December, 2022. This is Rob Sin at Goldfinger on CEO.ca, at CEO Technician on Twitter. And I would like to make a quick video highlighting a sector that I view to be a growth sector for 2023 and over the coming decade. And that is the uranium sector and nuclear energy as a whole. So later this week, perhaps Wednesday or Thursday, I'll have another video talking about more specific ways to play it, certain companies that I like and have in my portfolio. This is sort of a broader overview. So when making an investment thesis, I like to have a broader theme. So what are some big shifts, some big trends happening in the world? Well, one of them is the world is getting more energy intensive. We need more electricity. That's one, as you can see on this chart from the Cameco presentation. So the world is going to need a lot more electricity over the next 30 years. Electricity use is going to almost double from 2020. And then decarbonization. That's an obvious theme that's talked about all the time. So we're getting off of fossil fuels. So we're going to need a lot more electricity, a lot more energy, but we're not going to use as much coal or crude oil or even natural gas to generate that electricity. So what fills that gap? And then the conversation goes to nuclear energy. I mean, it's a no-brainer, and the conversation has only gained a tremendous amount of strength over the last couple of years. And actually, to make this video, I had to limit the number of tabs I had open because I could just go on and on showing links and news articles about Germany making a U-turn on nuclear energy. The Japanese are making a U-turn on it. China is building more nuclear power plants. So is India, right? And we could go on and on. The U.S. Is also having a conversation about, refurbishing older plants and having them live longer, and then potentially building new ones. So the fundamental case for more nuclear energy over the next couple of decades is extremely strong. It's very compelling. And if we go to the uranium sector, so mining the fuel that powers these power plants, we use the URA, Exchange Traded Fund. And the uranium sector was in a protracted bear market that started with the Fukushima accident in early 2011. It was actually March 2011. Some would say the sector topped even before that, but let's just use that as the date. And it bottomed during the March 2020 COVID crash. So that was a 9-year bear market. You can see evidenced in this chart, and actually I could pull it back a little more so you can see the full extent of that bear market. Boom. A brutal bear market where many stocks dropped 90%. Right? So if we know market cycles and know how these cycles tend to work, when you have a 9 or 10 year bear market, you should usually at least expect a 3 to 5 year bull market to follow at some point, and sometimes even longer than that. So if March 2020 was the beginning of the current bull cycle, then we're not even 3 years into it. And it's also quite natural that after the very strong impulsive thrust off the bear market bottom, we have a consolidation for 12 months, even 18 months, that serves as a continuation pattern, speaking technical analysis, for that broader cyclical bull market run. So wave one, wave two, consolidation, forming a continuation pattern, and then wave three. If we're talking about this in terms of wave analysis, just a simple way to think about it. But my base case is the sector, the URA, and some of the big stocks in the sector like Cameco, or next gen or energy fuels. They're consolidating and forming a continuation pattern for a longer term leg higher. Now you can look at these charts on all different time frames and make slightly different analysis. All depending upon if it's an hourly, a daily, a weekly, a monthly. I'm looking really big picture monthly, and the volume profile, volume trailing off as the price range narrows, is absolutely characteristic of a continuation pattern within the context of a bull market. So I wrote a blog post a few weeks ago about the sector, and I added a few points here: bullish market fundamentals. So the world is undersupplied, and it's likely to stay that way throughout this decade. So there's no sign that that is really going to shift unless the price of uranium goes up substantially. So at $50 a pound of U3O8, or $55 a pound, or even $60 a pound, it's not a high enough incentive price to bring on new supply. I think the incentive price is more like $80 to $100 a pound. Now, if we got up to 80, that would certainly cause some rebalancing in market fundamentals. But at the same time, if we saw spot U3O8 go from the 50s to the 80s, the URA and many stocks in the sector would go up 100% or potentially even more than that, right? New contracting cycle is underway. So this is something that is kind of specific to the sector. The nuclear power plant operators, the utility companies, they contract the supply of their fuel 5 to 10 years out, right? And so they're often operating on older contracts, and it's only when they need to re-sign the contract, sort of like signing a new lease to an apartment, the price has to be reset. Okay, the price has to be agreed upon by the buyer and the seller, right? So we're having a new contracting cycle underway, and it's interesting that Cameco just signed a supply agreement with CNNC, the Chinese national corporation that builds their nuclear power plants and sort of in charge of that of that industry in the country. And there was a very opaque agreement without terms or details. But clearly, this is for millions of pounds and potentially tens of millions of pounds. And speculation is the price in this contract was probably closer to $75 or $80 a pound than 50. But we don't know that, obviously. Now, also, the uranium market is now becoming very local, friendly countries versus unfriendly. Kazakhstan, the world's largest, supplier, obviously friendlier with Russia than it is with the U.S. So Canada and the U.S. are allies, and a lot of the supply, the new mine supply in Canada, is obviously friendly supply. So that, in theory, could trade at a premium in the West relative to the unfriendly supply. Uh, China has 150 nuclear plants coming online in the next 15 years. That's a lot. That's a lot. They're going to need a lot of uranium. And then you have the SPUT. Okay, so this is the Sprott, uranium trust, and they're accumulating U3O8 and taking it off the market. So it's creating an even tighter spot market. So the fundamentals for the uranium sector, the long-term fundamentals, are very strong. And we are in a little bit of a lull, that obviously in 2022, the market started the year pretty hot, just like the oil market went to 130 a barrel in March. And with the Fed raising interest rates from 0 to 4.5%, it's tightened everything up, and it's caused markets to pull back across the board. The uranium sector is no different. Also, the URA has a pretty high positive correlation to crude oil, 74% positive correlation. So crude oil just in the last month has come down from above $90 a barrel to $70 a barrel. So obviously Cameco pulling back from 25 to 21.50, next gen pulling back from 4.70 to $4. Not shocking when you consider the high correlation of this sector to the oil sector and to the price of oil itself, right? So if you think oil prices are going to keep going lower in the first half of 2023, maybe there's no hurry to buy these stocks right now. But if you're like me and you think probably $70 is a pretty strong long-term support, and the fact that the US is refilling the SPR beginning in February, that's going to add a floor under the price of oil. So the risk of buying the stocks in the URA over the next couple of weeks, in my opinion, is relatively low relative to the potential upside of this bull market continuing at some point in the first half of 2023. Here's a good graphic. I think I shared this on Twitter. I'll share it again, showing new capacity being built. Obviously, the China's in yellow. You see 2021 through 2040, they are the big builder, big new capacity. They're going to need uranium, a lot of it. Okay. And then, over here, 2041, you see G7 members. Okay, that's 20 years from now. I wonder if some of that will get pulled forward as countries want to take their energy sovereignty into their own hands. Instead of having to import oil or natural gas or what have you from unfriendly nations, maybe it's time to build their own nuclear power plants with all the new incredible technology we have that make these plants so much safer than they were in the past and so much more efficient than they were in the past. I think that's going to be a theme that we see increasingly. This article, look, Japanese had shut down all their nuclear power plants 2011, 2012. Well, now they're not only saying that they're going to be refurbishing and turning on the existing plants, but they might build new ones. So this is a big about face in policy because, Japan doesn't have oil, right? They don't have natural sources of, energy, of baseload power that they need for all their industries. Remember, Toyota is based there, and there's a lot of big corporations that do manufacturing in the country. They need electricity, safe and reliable electricity, and cheap, right? So nuclear is a theme that I just see continuing to grow over the coming years. And obviously, the stocks in the sectors will be affected by the broader market, tailwinds or headwinds. But bigger picture, this is a secular theme that will weather any economic storm because it's so powerful. And the case to switch coal-powered power plants, crude oil-powered power plants to nuclear is compelling. And then also we just need new electricity. We need new sources of electricity to expand the power grid globally, and nuclear is the natural choice. You can see the U.S. is filling its strategic reserve, buying almost $20 million from Energy Fuels. So we'll see more of this. Again, that's more supply being taken off the market. And then just some stocks. So Cameco, CCJ, this is like the keystone stock in the uranium sector. Again, tremendous bull market move from 2003 to 2007. So that was almost 5 years, and it was a meteoric rise. And then it went into the protracted bear market. You could even call it two bear markets, 2007 to 2009, and then 2011 to 2020. if this is anything close to the 2003 to 2007 bull run, we're probably about halfway or not even halfway here, in terms of the magnitude and the length of the move. Well, we've got at least another couple years, uh, you know, in the sector run. And then, just showing the daily chart, the URA, this is a mess. The chart's a mess. It's in an oscillation. Price is under the 50-day and the 200-day moving averages. So you could argue that it's in a downtrend shorter term. But the way I see it is I want to buy these stocks on weakness near the bottom of their recent ranges and then hold into the resumption of the long-term bull market trend. So I want to have a core position in my favorite stocks in the sector, and then I want to have a trading, a trade on where I can take profits shorter term into strength, but I continue to hold a core long-term holding in either the URA, CCJ, or NXE. And again, this is the weekly chart of NextGen, which is one of my absolute top picks for 2023 that I think will has a good chance of being acquired at some point next year. You can see it's just been in this oscillation, support around 340, 350 on the NYSE, and the resistance is around 480. And we're sort of in the middle of that range right now on the weekly chart. So again, I want to buy closer to the low end of the recent ranges and accumulate a core long-term holding that will hold for a couple of years for the resumption of the secular bull market and this continuation pattern breaking out to the upside. Also, I want to talk about risk. So the risk is very clear. The black line on this chart of URA, about 1750. If we got a weekly close under 1750, I would have to reconsider that this is a cyclical bull market still. So that's risking about 10%. That's pretty clear. And the risk of 10% versus the potential upside, which could be 30, 40, 50% or more, is certainly well justified in my estimation. So I hope you enjoyed this video and look for my next one later this coming week.